Massachusetts. So tonight, we have a very exciting, unrehearsed event featuring two of the very best-known figures in the investment community in dialogue with one of the best-known journalists on Wall Street, and we're very proud to say that these two best-known figures are, in fact, both UCLA Anderson alums. Our first guest is Larry Fink, the chairman and chief executive and the CEO of New York-based BlackRock, which oversees the management of more than $450 billion in assets. According to a recent article in Business Week, Larry became a bond guy solely by accident after graduating from UCLA Anderson in 1976. His goal was a career in actually real estate finance. But one of his UCLA Anderson professors, a squash partner, and I really don't know who that was, I hope he tells me, suggested that he interview with New York investment banks. He started at First Boston in mortgage securities, and by 28, Larry was First Boston's youngest ever partner. And the rest was history, and I'm sure we'll hear more about his career over the course of the evening. And our next guest, Bill Gross, is often referred to as the Bond King, the founder and managing director of PIMCO, headquarters in Newport Beach, managing almost $600 billion in total assets. He's the author of two books, one entitled Everything You've Heard About Investing is Wrong. Bill graduated from UCLA Anderson in 1971 and began his career as a professional blackjack player. We don't teach that at Anderson, I might add. And since then, Bill has been named by the New York Times as the nation's most prominent bond investor, and he and his team have also been honored with Morningstar's Fixed Income Manager of the Year award twice, an honor that this year went to yet another UCLA Anderson alum, Tad Ravel of Metropolitan Asset Management, a 1990 grad. So we have a pretty good track record there, I think, in finance. And guiding the conversation tonight is Alan Sloan, Newsweek's magazine's Wall Street editor since 1995. Alan's 30-year business journalism career has included being a nationally syndicated columnist while at Newsday, a staff writer for Money magazine, and an editor for Forbes. He's a contributor to Public Radio's Marketplace and frequently appears on the PBS program Nightly Business Report. His journalism is award-winning. Most notable for UCLA Anderson is the fact that Alan is a 6-time winner of the Gerald Loeb Award, which is business journalism's highest honor. In addition, Alan also received the Gerald Loeb Lifetime Achievement Award in 2001. This is particularly meaningful to us here at UCLA Anderson because the school has presented the Gerald Loeb Award for the last 31 years. So, please welcome Larry Fink, Bill Gross, and Alan Sloan. Come on.
Thank you. After that build-up, the three of us decided we wanted to stay back there and hear more about how wonderful we are. And, feel free to, Dean, to come back to the podium and tell us. All right. I'm sort of unique among the three of us that I never went to UCLA, and had I applied, they would have laughed at me. But nevertheless, I have managed to survive and prosper, and like the three of these, like the two of these gentlemen, I'm in my business by mistake, so we've bonded. And I was a failed sports writer. And what's amazing is you really are, with the two of them, in the presence of greatness and $1 trillion. I mean, there's more than $1 trillion represented on this couch. And, isn't that right? That's true. And the idea is how we can get some by the end of the night. But before we start, I just want to point out that there has been an enormous bull market in bonds. Everybody knew about the bull market in stock. These guys, by accident or design, I think design, no matter what they say, have done a great job for the bull market for bonds, which actually started in 1981, appears to have ended in 2003. And since bonds aren't quoted on the TV every day, no one even realized it except them. And they're investors because, let me tell you, I mean, their bond people have done very well, the people who have bond money with them. If you were an investor in their companies, you did phenomenally well. If you had bought PIMCO when it came public and held it till it sold, you earned just under 30% a year compounded, which is not bad. If you had done what I should have done and bought BlackRock when it came public, I think it's about 35% a year compounded. So, I mean, this is wonderful. So these guys are not only good investors, they're also good creators of wealth for themselves and others. And you'll keep that in mind when you ask them questions, so be respectful. And make up for me. But you know, there are certain cliche questions we have to ask, and I'd like to ask both of you this, and you could draw straws for who answers. Is either one of you going to miss Alan Greenspan, and if so, why or why not? Larry, why don't you go first?
When I was back at First Boston, I used Alan as an economist, and he provided us with quarterly lunches, and he told us what was going on. Quite frankly, Alan was not a great economist. And so, but, however, as a Federal Reserve Chairman, the man was brilliant. He basically allowed the market to handle situations. The market, he understood markets, and he understood that the dynamics of the markets will sort itself out. And so, you know, the Greenspan talk was to obscure everything and allow the market itself work itself out. So, I mean, he has been the ultimate in free market, as a free market Federal Reserve Chairman. And so we all benefited from his 18 years. Do I think we'll miss him? No, because I think Ben Bernanke and the Federal Reserve understand the role of the Federal Reserve is to allow the market mechanisms to work. And intervene when they need to, and talk a little more demonstrative. But so I think the institution will be fine without Chairman Greenspan, but his legacy is going to last a long time.
Brother Gross?
Well, in part I agree, I guess, and I suppose I have to be careful.
He's gone, Bill.
Don't
worry about it.
He worked for
we're now in negotiations to have him out to our March PIMCO investment conference.
What if
so
you
we have to
charge
be
him?
careful.
I
At 150,000
right.
per.
Jesus. I hope that's the management company, not the clients. But I'm sorry. Go ahead.
Anyway, I think he was a great fireman. He came to the rescue and provided massive doses of liquidity at the appropriate time, and there's no doubt that there were many of those times, beginning in 1987, and I suppose most recently in 1998 and the like. I suspect that his not his legacy, and perhaps his legacy, but certainly what he turns over to Ben Bernanke is a result, to some extent, of that liquidity. You can't continue to pour money into a system and not have that system take it and generate massive amounts of debt, and in some cases speculative bubbles. And that's not to suggest that Greenspan was responsible for the NASDAQ bubble, nor even if it exists, the housing bubble. But there's no doubt that as the world's primary central banker, he has presided over a massive buildup in liquidity that one day will have consequences.
Let me ask you that now, two questions. Instead of the UCLA Anderson question, which I'm supposed to ask now, I'd like to actually follow up with what you said. You know, I have to occasionally act professional. All right, first of all, do you doubt that there's a housing market, a housing bubble in some markets? And second, since you're even more pessimistic than I about things like all the vendor financing this company is getting from China, how do you think this all ends?
Well, it doesn't necessarily end with a bang. It may end with a long whimper, simply because the U.S. economy, in my view, is being hollowed out. The game has moved to Asia and parts elsewhere. And to the extent that we've lost our manufacturing edge, we've suggested that we have a knowledge technological edge, but that in turn is at risk simply, in the face of the Chinese and others producing more scientists and the like than we ourselves do. And so the claim that the United States superiority will continue to prevail, I think, is certainly at risk. And so it ends, perhaps with a bang in terms of a liquidity implosion if the Asians and the Chinese and others decide to sell those bonds. It's certainly not in their interest, but it could happen. Otherwise, it ends gradually over time as the tremendous liabilities that we've generated, not just in terms of paper, but in terms of pensions and health care, have to be paid. And that's something that we haven't faced up to yet.
Larry?
No, I certainly don't think we have a housing problem. The marketplace self-corrects. There are going to be some areas where the housing market will experience some difficulties, and some people will have delinquencies and ultimately defaults. And, one interesting point, Fannie Mae and Freddie Mac the last few years are making money on delinquencies. That was the first time in their history.
How does that work?
Because, housing prices have gone up. And so when they have ROI and they hold it for a while, they sold it for a profit. And
that's foreclosed real estate.
But that's an anomaly, and that's just an example of what is experienced in the housing market. And, maybe the marketplace goes into a more normalcy and we're going to have some defaults and people will lose money on it. But I don't look at that as a major issue in our economy. Even everyone's talking about the problem with the adjustable rate mortgage and all these teaser rates. The housing market is the most competitive market in the country. We've had basically a flat yield curve. A lot of investors, housing investors, have now rolled into fixed rate mortgages around 6%. And the ingenuity of the housing market is able to accept new structures. So I'm not worried about housing. I am more worried about the dependency that we have on foreign investing in the U.S. market. Everyone talks about the current account deficit or the balance of our basically current account deficit, and it's about $500 billion. But as of last month, the Treasury data is saying foreigners are buying it. Annual rate of $1.2 trillion of debt. And, that just can't continue. It feels really good now. We as bond investors are winning a lot of mandates from overseas clients. It's a virtuous circle, as Bill discussed. They're selling us goods. They get dollars. They invest in those dollars back into the United States in the form of bonds at lower interest rates. Lower interest rates helps the housing market. Housing market circularly helps the consumer. So it's worked. When I go overseas and talk to our Japanese, Chinese, and Middle Eastern clients, they would like this circle to last forever. And they're all very happy with this model. And that's what frightens me. Everybody likes this model. The whole world is dependent on this model. I don't see what's going to change this model, but I think back in 1999 or 2000, we knew the internet bubble was a bubble, but we had no idea at that moment what's going to break it. And I would say we have the same problem today. We are terribly dependent on our economy to fund our deficits. It works really well for the Chinese and us and the Middle East clients, but it just feels too good. And so as a cynic, it's not going to work forever.
So why, since you're pessimistic one way and Bill is pessimistic a different way, it is always nice to talk to gloomy people.
But we made a living by being gloomy.
You took my line away, Larry. But you have to change chairs. Why would and if you don't want to answer this, we'll answer. Why in the world would you buy the long government bond at this rate? I mean, why would people buy them?
Well, you would buy it if you thought that inflation, which is the ultimate enemy of a bond investor, is well contained, or even God forbid.
Deflation.
Or Bernanke forbid.
the big D.
Yes, with a helicopter, that we had deflation ahead. And while that's a small possibility, it's certainly a probability, and the larger possibility just might be that inflation is well contained, because within the context of this virtuous circle that Larry mentioned, is the Asian equation, so to speak, the import prices, the competition, the dampening effect on U.S. labor that in effect is helping to keep U.S. inflation down. And so if you felt that inflation could either be targeted by Mr. Bernanke at 2% or otherwise contained at 2%, then yes, a 4.75% long bond would be a decent, although not historically a extremely attractive investment.
Larry, if you don't want to answer, we'll give you a pass. Do you want to answer the question?
Well, I don't disagree with Bill's view. I think we're going to be in an interesting period in the next year. We all talk about the circle, and we all talk about the value of the long bond. The long bond has not been tested in 4 years. The Treasury stopped issuing long bonds for 4 years.
All right, why don't you tell people what you mean by the long bonds?
Well, the 30-year Treasury the government thought that our deficits would go away at that time, and therefore they stopped the issuance. And so during this 4-year period of time, in the same period where the deficits grew dramatically, so the Treasury had to issue a lot more debt. The average duration or average maturity of Treasury debt collapsed over the last 4 years. And so this is the same time when we've had basically a pretty good bond rally and a lot of foreign demand. The Treasury did announce now that they're going to reissue the 30-year Treasury. That's going to happen next week with $15 billion. And so this is going to be the real test over the next year. Can the market handle more duration? So in the next year or so, we're going to actually see Treasury issuance with a longer duration, which obviously has longer risk profiles. It's going to probably satisfy a lot of the demand out there for pension liability management. But the real test will be, can the market handle Treasury issuance? And I would just like to add one other thing about long paper. It's interesting to note, we had a real market event a few weeks ago with Oracle issuing debt. Now, when did technology companies issue debt? Technology companies always issued stock because their stocks traded at ridiculous prices.
Right.
Okay, they're not trading, at historical ridiculous prices. Maybe at their maybe their earnings momentum will prove they're still ridiculous, but let's assume on historical P's they're certainly less ridiculous. And so Oracle is now issuing long-dated debt. Intel has announced they're going to issue long-term debt. So we now have a different paradigm. We have Treasury now issuing long-term debt. We have British issuing 50-year debt overseas, and now we have even technology companies not issuing more stock in acquisition, but issuing debt. And so I don't know where we're going, but I know we are going to be tested on the relationship between 10s and 30s in the yield curve.
Okay, and the last question is, would you let your children buy a 30-year bond?
I
mean, we want them to do drugs. Can they buy a 30-year bond?
Yeah, if they're going to do that, buy 30-year Muni Zeros, because they actually trade at a much higher yield. And if you want to lock in something, that's what I would be buying.
Oh, okay, I'll get the specifics later.
Yeah, but
Bill, I mean, you're young kids.
What they should buy, if they were buying bonds, and if you were concerned about what governments inevitably do, that is to reflate, inflate, to gnaw away at the edge of those Roman coins that I guess was the first inflation, or maybe there was something before that, but you get the drift. If you're concerned for the next 30 years in terms of the potential for our government to reflate in order to basically to minimize future liabilities and obligations, which would be a natural response, you would want to own one of those fabulous inflation-protected securities, a TIP. Yeah. You would want to buy a 2% real rate and devil may care where the inflation rate
As
is.
opposed to a 4.5% nominal rate for
correct.
30 years.
That's correct.
By which point we'll all be in the old age home, at least the three of us will. All right, now before I forget, before Dean Rotner kills me, because I promised him I would do this, I have to completely change the topic and ask about the UCLA Anderson School and what role this played in your stunning success and you're both becoming so rich, and more to the point, for the people in the audience, how many of them will you hire and when? Bill, I mean, you seem more voluble. Why don't you go?
Well,
You have to tell the truth
The
now.
hiring goes on. We do hire lots of UCLA MBA graduates, and they've been some of our best idea generators and thinkers. So yes, that continues, and even more so because I was here. Secondly, though, in terms of my beginning, I did, in addition to my blackjack experience, which Judy mentioned, because that was a book written by Ed Thorpe, who's down at UC Irvine, some of you know, and because at the same time he was writing a book called, instead of Beat the Dealer for Blackjack, Beat the Market, which was a convertible arbitrage type of idea way back in the late 1960s. That sounded like a fascinating idea to me, and I used it as my thesis here at UCLA, and used it to get a job at Pacific Mutual / PIMCO. So it was the direct link to my career.
So you took basically a boring topic, went to work for a mutual insurance company, and made a fortune. It must have been UCLA, clearly.
It was.
Larry, be nice now. You live in New York. I know where you live. So.
Growing up in Los Angeles, and I really did not know Wall Street at all, and I really was searching for what I wanted to do, and I had the good fortune of going here as an undergraduate, and then immediately going into the graduate school program, and I was lucky enough to have a research assistant job that allowed me to survive and pay for my bills. But it just allowed me, the school gave me the backing to do what I did, and it gave me a lot of it, the confidence. I mean, I think that's what so much of a graduate school program should be, is to give you some tools and confidence to get out in the business world. In terms of hiring, BlackRock hires, I think this year is 120 young kids this year, both undergraduate and graduate, and UCLA is a part of it.
Much smaller.
And hopefully, and hopefully,
You're owned by the
they.
Germans.
What's that?
They're thrifty. I mean, you're owned by Allianz, right? It's the thrifty
I said
Germans.
we're much smaller, and he said you have to be thrifty. You're owned by the Germans.
I'm sorry. I shouldn't say that. That's politically incorrect. I withdraw the remark. Forgive me. But go ahead.
No, I forgot my train of thought.
It doesn't matter. No, but okay. So all right. We're done with UCLA. Was there? did either of you? I mean, Bill has. I made the mistake of actually reading Bill's book. Do you see this?
I don't even have one.
Maybe he'll sign it. It says here, the Peter Lynch of Bonds Newsweek. So I looked at this. I said, God, did I say that? And it turns out I didn't. Actually, someone else did it, and he was quoting Business Week.
I think that's true.
It is true. And Business Week was in turn quoting somebody else.
I think that's true. That's how these things get started.
That's how these things get started. And on the front, it says Newsweek. That's probably because I guess Newsweek is a better seller than Business Week. Now, speaking, but that's until I go to Business Week, at which point I'll just sue for libel or something. But we were talking about some of this before, and I hope the people here would be interested. What do you guys generally think of the cover, the picture of the economy and the bond market as presented in, God help us, the news media? Do you think it's good? Do you think it's bad? I mean, leaving me aside, do you think people do a good job of writing this stuff or displaying it or putting it on TV?
Are you speaking to the bond market?
No, I'm speaking
just to the markets.
I'm speaking to the markets and the areas where you know stuff. I'm just curious what your reaction is. And maybe it's a bad question, in which case I won't ask it to
Are
Larry.
you asking us if we think your profession does a good job?
That's what I'm asking.
No.
I don't disagree, but it's fine.
No, I mean, we were talking about it earlier.
That's exactly what I'm asking.
You know, I hope there's a Wall Street Journal article reported on here. It takes me about 8 minutes to read that, and I could read the New York Times in 25. So it's certainly in the bond market is a very obscure market. So a lot of the reporters don't have the tools or the knowledge to understand it. Obviously, the stock market is quoted, and obviously it's easier to digest the information and understand the information. But no, the typical reporter today needs 15 seconds, and that's all they have. And you know, the market's a little more complex than a 15-second answer.
Brother Gross?
Yeah, I think that's true. The real problem, other than the day-to-day, which the press tends to focus on, I mean, that's what's topical, that's what's interesting.
Sure.
The prices go up or down. You know, the markets, in terms of imparting some type of understanding to a public, are driven by, you know, significant long-term forces, whether they're demographic or financial or geopolitical, and those take lots of explaining. And in some cases, as I'm sure with your column, they take years to explain. You can't just do it on a page. And so that I think is the particular problem in trying to, first of all, to grasp the understanding, and second of all, to impart it to a public over time. You know, the public demands immediate gratification from the standpoint of information, and it's very difficult to do that within that medium.
Right. Do you think, if there is such a thing as collectively in society, do you think that we'll call it the United States, for lack of anything else, is really too short-term focused, is just right? Do you think all the internet and the speeding up of stuff has caused people to think too short-term? And, you know, it's just a question that occurs to me from what you guys have said.
Yeah, I mean, I think that's a whole societal issue. You know, but I think the issue is more than just our attention span. I think the capital markets is a very complex. It's a very complex business. It's very difficult to understand. I don't think most investors really understand what has happened over our last 25 years in the capital markets. You know, as a CEO of a public company, when I meet investors, I don't think most investors today understand the transformation of the global capital markets. So if investors who are theoretically supposed to understand what's going on, you know, it's very difficult for you know, the public to understand. And you know, the capital markets has transformed our business. You know, the role of the capital markets and the ingenuity of Wall Street has packaged and structured securities on a global basis. The capital markets has grown so fast that the responsibilities in the capital markets by banks and insurance companies have been diminished dramatically. It is a role of long-term investors like PIMCO and BlackRock and Wellington, and all these investors are playing a bigger role today than 20 years ago, and that's a very hard, complex issue. And the role of the Saudis and the role of the Chinese and the demand for security. So it's a very complex issue. So whether we had, you know, the internet in a 15-second blip, or we have, you know, a thorough research piece, it's evolving so fast that I think it's hard for people to conceptualize and understand.
And I think that's true. And today's short-term focus is probably best typified, in my opinion, and I'm sure many of you would agree, by Jim Cramer on CNBC. I mean, it's a 5-second decision. It's a buy, it's a sell, it's a booyah. You know, that's what we've either evolved to, or or become, I guess, as a financial society at least. And if that's the way we make decisions, then certainly as a society and as a country, we're in trouble.
Well, good. On that happy note, it's time for questions from the audience. And just don't ask Larry about Morgan Stanley and whether he's selling, because he'll say no comment. But feel free to try, but that's what he'll tell you, because it's what he told me. All right, you're going to hand people the mic. All right, is there a victim? Ask something.
Just ask one or both of you. What do you think explains the recent resurgence of gold as an investment?
I've got a good one for that. It may not be the correct answer, but I think it's pretty good. And maybe some of the finance professors out there might agree with me. Maybe they won't. But in recent years, in the past 5 or 6 years, we've seen a dramatic reduction, not just in the U.S. but elsewhere, in terms of real interest rates. And to the extent that real rates are the drivers of asset prices, whether it be a home, whether it be stocks, whether it be anything that has a derived future value, then ultimately gold as such would have to be revalued higher, much like everything else. And what we've seen, in fact, is just that. We've seen real interest rates as exampled by a 10-year tip in the United States fall from 4% to, as low as actually 1.25%, and now close to 2%. But that's a halving in terms of real interest rates, and it undoubtedly has affected not only stocks and homes, but gold prices too. And it's a fair question to ask whether or not the current gold price has accurately discounted the halving of real interest rates over the past 5 years. I'm not so sure we're there yet.
I'm not sure what that means, but that doesn't matter. Larry, do you want to answer the question?
No, I think gold is just a reflection of global liquidity, and it's no different than most asset classes. Actually, gold has underperformed contemporary art.
Really?
It's actually underperformed Los Angeles real estate. It's just an asset class. It's a store of wealth. I agree with Bill. It is a reflection on low interest rates. And there is also that point, the other important point, that there's much greater usage of gold. I mean, as Asian wealth has increased, the demand for jewelry has increased on a global basis. So you have a greater demand, and you have liquidity, and I think gold is a good reflection of global liquidity and demand.
Right, and just one additional point, Larry brought it up, I think it's true. Recently at the margin, it would seem only reasonable to me that an Asian central bank or otherwise would want to diversify away, certainly from the dollar, and maybe even from currencies in general. And so there might have been a bid imparted to gold in recent months and in quarters on that basis alone.
So you think central banks may be buying it, and that's what's helping run up the price?
Well, it would be logical if you were stuck with a near $1 trillion of U.S. Treasuries, which were susceptible to reflation, then
right.
Gold would be a logical hedge going forward.
Don't tell the clients, though. Right, you're not in the gold business, though. You guys are in the bond business.
Actually, we're in the commodity business, but...
Tell me later. Anyway, all right. Wait, there's a gentleman in the front row. Whoops, wait a minute. Okay, excuse me.
There's another $1 trillion industry that's not represented here tonight, which I'm sure you guys think a lot about as successful financial entrepreneurs. That's the hedge fund industry. I'm curious whether you guys think this is the wave of the future for money management. And if not, why not? If so, what are you doing to position yourselves to profit?
Such a good question. This could take lots of time, I'm sure. And I'll be brief to give Larry his shot, too. I think a hedge fund is just an unregulated bank. It makes money by borrowing money short, either lending long or investing long. That's their business. And they've been successful because of the leverage and because of this very positive yield curve. Now they're coming upon hard times, and lo and behold, the real reason is that they can't borrow at such an attractive rate. It's not that because they've lost any of their supposed brilliance, it's just that their financing has disappeared. You know, the future of the hedge fund business is a future that in part is going to be determined by the yield curve, which at some point may get more normal. But it also will be due to the realization on the part of the investment public that the type of fees that are paid for hedge fund management cannot be paid in a 4, 5, 6, or 7% return world. It just can't happen. You cannot pay a hedge fund manager 2 to 3% and be willing to take 4 or 5% yourself. It's not an appropriate risk-return ratio as an investment management business. Larry?
We manage a lot of hedge funds at BlackRock. I think there's a role for them. There's a role for long investing too. So I don't look at it as a binary business. And I think the question was a little too binary. But so I think there's a big role for hedge funds, be it in long-short equities or a commodity-driven or event-driven business. And but I agree with Bill in terms of the fees and the compression of hedge fund returns. But I think it's going to be a growing business. It is, because it is an unregulated business, you have a lot of smart intellectual people moving into that business. And I think the investment business is going to be bifurcated into these large pools of investment firms like PIMCO and BlackRock and others. And you're going to have these spin-offs where these individuals are going to survive on their wit. And it's going to be a good business. I can't say, and I'm sure Bill will say the same thing, our clients are screaming for solutions right now. Most of our clients worldwide cannot afford a 4 3/4 rate. Their liabilities are a lot higher. And we're talking about from insurance companies and pension funds. Everyone from Germany to China to the U.S. are having the same difficulty. And so right now there's this belief, whether it will prove to be correct or not, that we're going to make those returns in the alternative space. And that may happen. In some cases, you're going to have some real pockets of brilliance, and they're going to achieve those excess returns that are needed. Whether a diversified portfolio of hedge funds and alternatives will that create that excess return will prove out. My greatest fear about hedge funds and alternatives is if we have a change in the market dynamics, and the change is in the terms of liquidity. And the hedge fund industry has flourished really since 1998 because it had unprecedented liquidity and unprecedented allowance of leverage. And, you know, leverage in the financial system is 80 times greater than it was today, this is the Federal Reserve statistic, than it was during long-term capital. Just to give you an idea of, and so the market has accepted risk at the greatest proportions we've ever seen. And if there's something that changes that liquidity, that's what I'd be frightened of, because I see so many long-term investors now going into the hedge fund community and investing. And, you know, when we've seen it in the past in our careers, and I can tell you I've lost a lot of money in those episodes, you know, when the door closes, it closes really quickly, and we're all running out the door at the same time. Well, all I can say is I've never seen more investors who are in that position now. So, you know, because no one is talking about the door ever closing. Everyone assumes the liquidity we have in the system today is going to last for the next few years, and that is a frightening thought for me.
And you don't think it is?
You know, I don't see any evidence that it will not. So I'm not, but I didn't see any evidence that's going to blow up the internet market in 1999 also.
Okay.
And so, you know, I tell my clients, I know it's going to blow up. It's either going to be in 2 weeks or 10 years, and can you tell me? Because I don't know.
Well, okay. There was a question down here. Do you still want to ask it? Yeah. Please, and I'll repeat it. Oh, wait a minute. The mic is here.
Yeah, with the current deficits in the United States building up, and on the other hand, the surpluses building up in China and India and these other countries, Larry, you took a kind of, in my opinion, kind of a tactical answer to this. I want a strategic answer as to what can happen in the long run if, in fact, these other countries that have our reserves decide that this is not a very good investment, that the United States, okay, it is the safe haven, but on the other hand, they feel that they can get better interest rates somewhere else, and there's other alternatives if you're talking about. So what happens if all of a sudden these folks decide to shift their surpluses from the United States to somewhere else, and we don't have that liquidity that we've had all the way along?
Well, I don't think it's going to be that binary. I think it'll be granular how that happens. And it's going to happen if two ways. One, if the Japanese economy continues to do well and there is some evidence of inflation there and they start raising rates. And the arbitrage, as you suggested, with Japanese rates and the U.S. rates, that arbitrage goes away, and you are going to see some significant rebalancing out of dollar-based assets into, let's say, yen-based assets. The other thing that's probably more frightening over the course of the next 4 or 5 years is what happened if the Chinese economy, the Japanese economy, the Middle Eastern economies continue to do very well, and that they need to build more roads and more schools and more factories, and they have to now, instead of just invest, they have to rebuild and build. And so this is that granularity that you're going to see in the economy, that indeed they can't have that store in dollars anymore. They have to reinvest in their local currency, local economy. To me, that's a very realistic proposition if the world stays safe and kind. So what happens? We're going to have higher rates, whether we have a recession or not. I mean, that's the bad scenario that we all understand. Maybe it's a tail risk of 10% or 20%, and maybe it's 50 and we don't know it yet. But that's, in my mind, the greatest fear I have. You don't want to be the debtor nation that we are and continue to be that debtor nation if you believe the world gets safer, the world's economy is going to grow, and there's going to be greater granularity to the build-out of those economies, and they're going to need those dollars one time. So if we don't have a rebuild of our wealth to finance these deficits and past deficits, yeah, the outcome will be not good. So sell your LA real estate now.
So at the gross.
Because that takes longer to sell than a bond.
Phil, do you want to let that go?
Well, no, and not that I want to be long real estate in Los Angeles. I don't necessarily. I have it's not a theory, and it's not my theory. It's an increasingly popular answer to the conundrum, to Greenspan's question as to why interest rates on the intermediate and long end are so low. We know why they're where they are in terms of the short rate. It's because Greenspan wants to put them at 4.5%. But we're not so sure why the 10-year and the 5-year and next week the long bond are at the same level. And it's true that the yield curves do go flat, and they do, in academia, begin to anticipate future short rates and liquidity considerations and those types of things. But I think recently, the conundrum has been answered in part by, yes, the purchases of 5s and 10s by Asian and other central banks. An area that typically most observers had once felt that they never would buy, that they would simply prefer to buy bills and not take risk in 5s and 10s and longer debt. In fact, the statistics show that they have been the buyers of treasuries, the majority of which have been issued. They have been the majority purchaser over the past several years and have flattened this curve. And so, your question, can be answered from my standpoint in part by suggesting that if and when they decide not to buy, or even in your particular case, I suppose, decide to sell some, then the intermediate and longer ends of the curve, begin to go up in yield. We know the Fed can put that short rate wherever they want, but they can't put the 5 and the 10 and the 30 wherever they want, and that ultimately affects, lo and behold, the housing market, the cost of investment capital, et cetera, et cetera, et cetera. So we are at the disposal and the kindness of strangers, as Mr. Tennessee would have put it and did put it, and it's not a comfortable feeling.
All right, we're in the market now for one very short question that will elicit short answers, because in 4 minutes they're taking the stage away. Okay. The question is, since there was no mic, how do these guys factor in the threat of another terrorist attack? I think this will give you a short answer.
A real short answer would be that we feel that if something like that occurred, that the high quality front end of the Treasury curve would benefit, would drop immediately, and so there has to be some type of insurance premium in the form of a lower yield or a willingness to accept that. I'm talking about 1s and 2s and 3s, as opposed to before 9/11. And so PIMCO, and it's easy now because the yields are all at 4.5. PIMCO would be a willing buyer at what we deem to be a reduced insurance premium against a terrorist attack in the front end of the Treasury curve.
Larry, you have the last word of the evening. Don't let us down.
I think it's very hard to have that consideration in a day-to-day investment story. That's a risk that's embedded in interest rates every day. So I don't think it's something that we invest anticipating an event. I think it's embedded in the market today, and it modulates with different fears. I think in somewhat different than terrorist attacks. I think if you looked at interest rates and how they moved in October, November, when we thought bird flu could be a big issue, and we talked to scientists at BlackRock and asked, is there any remedy? And they said no, and they told us all the disaster scenarios and all that stuff. And so, I'm sure every other investor received some scientist telling us we're all going to be dead in a while, and so the market is pretty efficient, and so we're not getting a tip that somebody's going to be doing something, or bird flu actually is a real pandemic. But so I think the marketplace prices in these events. Obviously, if an event actually happened, obviously there'll be an immediate shift in interest rates. But I think the market's efficient and it's priced in, and we have to trade around that issue.
And that'll do it. It's been fun.
It's been 20 too short. Can't we keep going?
No. They're going to kill us.
Right.
They're bringing on the circus soon, Bill. So
right.
we have to leave. Make way for the elephants.
Actually, Bill, we can promise you that you can come back. When the center is fully up and running, this is a great example of what the center does in bringing great people, different people who actually had a lot of similarities in their outlook, and somebody who puts them on the hot seat and draws a great audience, and that's precisely the vision for this center. Thank you all, Bill, Larry, and Alan. And we have some small tokens here. All
right. Thank you.